Hello, welcome to this episode of The Financial Incline. I'm your host, John Bovard. Today, I'm thrilled to be joined by Adam Coffey. Adam is a CEO, board member, best-selling author, and acclaimed international speaker. With 21 plus years of experience as CEO, Adam built 3 national service companies for 9 private equity sponsors. During this time, he completed 58 acquisitions and has a track record which includes notable outcomes measured in the billions of dollars, all the while averaging a 5x multiple on invested capital at exit. As an author, he's written The Private Equity Playbook, The Exit Strategy Playbook, and Empire Builder, which all became #1 Amazon bestsellers. During our discussion, we dive into his book, Empire Builder, The Road to $1 billion. We discuss what growth metrics you should have in place as a business owner in order to continue to scale your business at a rapid pace. We talk about what EBITDA numbers you should get your business to if you're looking to get a private equity investment. We talk about the power of rollover equity, and how you can sell your business multiple times in order to scale to $1 billion. So if you are a business owner or an aspiring business owner and you're looking to build your $1 billion empire, make sure you check out my conversation with Adam Coffey. So Adam, thanks for joining me today.
John, it's good to see you. Hello to all your listeners out there.
Yeah, well, great. So Adam, for those that may be tuning in and watching this, listening to this, would you mind just sharing a little bit of your background with us?
Sure, absolutely. Look, I think for all of us, life is a set of experiences. I'm a veteran, U.S. Army. Military taught me something about discipline, leadership, teamwork. Engineering made me a meticulous planner. I'm a pilot. Pilots don't take off unless we know where we're going, and then we deconstruct the trip. Very useful skill later in life when I started running companies for private equity. I spent 10 years working at GE in what I call the Camelot era of GE. Jack Welch is at the helm. Tech doesn't exist. GE's #1 on the Fortune 500 list. That company is growing so fast that it's literally doubling in size every 2.8 years. GE taught me how to run a company. I then spent 21 years as a CEO building 3 different national companies for 9 different PE firms. I was a turnaround guy, who fixed the base company I started with, buy and build guy, bought 58 companies and, added them on top, and 2.5 billion in exits, as a CEO. I was teaching at university, was enjoying kind of giving back. I've written 3 #1 best-selling books. 4th one literally just came out today. And I got bored. I got bored being a CEO running one company at a time. I just turned 60, and I decided I'm going to spend the last 10 years of my career trying to educate as many entrepreneurs out there as I possibly can in how to use the same kinds of tools that private equity uses to create and generate their outsized returns, but teach smaller businesses and call it everyday entrepreneurs how to stack the deck in their favor and find success. And so that's what I'm working to do for the last 10 years of my career. Started a consulting business working with literally 68 different founder-led companies and about a dozen PE firms too. But teaching those founders how to scale, do M&A, and exit for top dollar.
Yeah. Well, that's wonderful. And for those of you that are listening to this, I highly suggest getting a copy of Adam's first 3 books, and then also his newest one that just got launched today. And the bulk of our conversation today will focus on the Empire Builder, which is the road to $1 billion. I love the ambitious goal of the $1 billion company, the $1 billion enterprise, and I love how you talk about private equity because it can be pretty scary, almost intimidating for most business owners. A lot of negative connotations there, but so one of the things that you mentioned in your book in Empire Builder is you have a preference towards service-based businesses. So why is that?
Yeah. So, in basic terms, literally, we can find success running any kind of company in any industry. But for entrepreneurs who are out there and they're just starting out, I talk about a profile of a specific type of company that literally will stack the deck in your favor and provide you with a higher probability of success. So, let's first, start with some statistics. 34 million small businesses in just the United States today. 34 million. Only 7% ever get to $1 million in revenue, and only 4% of those ever get to 10 million in revenue. So the odds are stacked against people kind of busting out and building, $1 million business, let alone a $10 million business, let alone 100 million or $1 billion. So I want you to be successful. So how do we stack the deck in our favor? I like service businesses. The reason I like them is simple. So the framework I lay out in Empire Builder is this. Let's focus on companies that take care of basic human needs, not wants. So I'll give you an example. I'm going out to dinner Friday night. My wife wants a new dress. My wife wants a new pair of shoes. Well,
Right.
if I'm unemployed and I don't have any money and she's unemployed and doesn't have any money, well, then we don't spend money on wants when we don't have it. We focus on needs. I'm sitting here in my office. It's a brand new building. If it was raining outside and water was pouring on my head while I'm inside, that's a need. I need to get my roof fixed. I don't have a choice. And so basic profile is if I focus on companies that take care of needs, then essentially I'm stacking the deck in my favor because the economy moves in cycles. And as an industry is cycling, with the economy, if my company is focused on needs, not wants, it'll be more stable. So the next attribute is contracted revenue versus project-based revenue. So, hey, I was very successful building a large-scale HVAC company, but think about my customers, and let's use residential as an example. I built a commercial company, but if you needed a new HVAC system, and you have me put it in today, well, you're not going to be a customer of mine for the next 10 or 15 years because you only buy one every 10 to 15 years. And so at the beginning of every month, I've got zero revenue and I'm looking for clients simply to replace the revenue that I had last month from an entirely different set of clients. That's project-based revenue. And project-based revenue can lead to really, lumpy results. I want contracted revenue. Think of like a pest control company or a landscape maintenance contractor, or, even, if you own a small business, think about, an accounting, payroll, bookkeeping company that takes care of your books and your needs. So, if I sign a pest control, I sign a contract. It's a contracted revenue stream. First of the month, they're going to charge my credit card. 3 days later, 100% of their revenue for the month is collected. It's in the bank. And so now when I find a new client, it adds on top of the revenue that I've already got rather than replaces revenue from a project-based company. So I like needs, not wants, contracted revenue instead of project-based revenue. Next up, low capital expenditures. So if I'm a product company, I have to manufacture a product. I might need a plant. If I'm Elon Musk and Tesla, I got to have these big gigafactories, in Texas that are cranking out cyber trucks. And, it's like there's a lot of cost, that's associated with manufacturing, and so if I have a services type business, generally, if it's a field service business, I have to buy trucks. That's about it. Trucks, lawnmowers, sprayers, if it's a pest control company. Think about professional services for a minute. Think about that accounting and bookkeeping business I talked about. In that particular case, I don't even have to buy trucks. The product is up here. It's in my head. So it's needs, not wants, contracted revenue, not project-based. Low capital expenditure means very high free cash flow conversion. Why does that matter? Well, for most entrepreneurs out there, they don't have a bunch of money. So if I want to buy, and buy several of these kinds of companies and put them together, I want to use the cash flow that's embedded inside the business that the business is generating to help service the debt that's required for me to buy it. And so if I follow this basic framework, needs, not wants, contracted versus project, low capital expenditure, high free cash flow conversion. If I focus on those basic dynamics, the chances of me succeeding are just astronomically higher than if I was focused on just some random, hey, I'm going to open a restaurant, or hey, I'm going to start selling purses. It's I can stack the deck in my favor, and the percentage of chance of my success is just going to be astronomically higher. So that's the kind of profile. That's why I like service businesses. A whole
Yeah.
lot less capital expenditure investment required to generate a ton of free cash flow.
Yeah, that's great. And I appreciate you sharing, those three pillars of what you're looking for. And I know in the book you also mentioned kind of a fragmented businesses where there's, if you open the white pages, you might see 10 to 15 different businesses listed there, which
Yeah,
is
so
also
let's talk
great.
about
So,
that for a second. When I already told you there's 34 million small businesses in the United States. I talked about bookkeeping and accounting. I'm working with entrepreneurs. I'm doing 3 roll-ups right now in accounting, bookkeeping type service companies. And when there's 1.8 million of anything, there's not enough buyers on the planet to buy all the small companies that
right.
exist in that space. And so the net result is I can buy them cheap. And a
Mhm.
typical accounting bookkeeping firm, it's like pick the industry. If it meets my profile and it's fragmented, my entry point is going to cost a lot less because there's so many of them. There's not enough buyers to drive up the price. And
Right.
then think about this statistic now. There's only 3,000 companies on the entire planet that have $1 billion in revenue. 34 million small ones just in the US,
Hmm.
but only 3,000 in the entire world that have $1 billion in revenue. 2,000 of them are public, 1,000 are private.
Yeah.
And so as we get bigger, we get rare really quick. And so
Right.
when I've got a bunch of small ones, my last empire was an HVAC and refrigeration service company. I bought 23 companies and put them together. On
Hmm.
average, I'm paying about 5 times because it's highly fragmented. There's not enough buyers. There's too many companies. They trade
Yeah.
for a relatively low multiple, 5 times. But when I put them together and I sold the business, I sold it for 14 times. So for
Yeah.
every
Yes.
dollar of earnings that I bought and paid $5 for, I turned around and sold that same dollar then for $14. And so
Mhm.
I make $9 of profit. This is called arbitrage. Arbitrage is naturally occurring. And so I don't even need to focus on buying fixer uppers. I only buy good companies. I pay fair market value. They meet my basic, infrastructure or tenants. And then when I put enough of them together, I get bigger. I climb above that pile of 34 million small companies. And
Hmm.
now that I'm bigger, I'm rewarded by selling for a higher multiple because there's fewer opportunities for the private equity firms that frankly are buying 50% of all companies sold on the planet. They've
Right.
created the market that allows us as entrepreneurs to build something and sell it and make a lot of money. And so now that I'm bigger, a bigger firm says, "Oh, look at this. Here's a great company
Yep.
and it's available." And I just, there's competition and fewer of them makes the price much higher. So I like spending my time in the lower middle market, combining small businesses that trade for low dollars, only good companies run by good people, good cultures, and putting them together makes them rare. And I get above the pile of smallness and I become rare. I sell for a high multiple. Arbitrage that's naturally occurring, creates the profit or the wealth creation that I'm trying to generate as an entrepreneur. So that's the basic magic behind fragmentation.
Yes, I love that. And in the book, you mentioned these different levels. So, under a million, the $1 to $10 million range, and then, 10 to 100, and then above 100. So for those small business owners that may be in that, under a million or under $10 million range, what are some of the ways that they can start to grow and to scale their businesses?
Yeah. So, great point. I call it the happy meal effect. When you're
Mhm.
under $1 million in revenue, it's all about unit level economics. It's about dialing in your business small. I can't tell you how many entrepreneurs have said to me, "Adam, if I just get bigger, I'll figure out how to make money." Wrong answer. We need to figure out how to make money small. We need to
Right.
dial in and perfect the mathematical formula to success. And and so what's the happy meal effect? Well, if I go anywhere in the United States, frankly, anywhere in the world, and I order a Happy Meal, I know exactly what I'm going to get. I'm going to get a red cardboard box that's got yellow handles. Inside, I'm going to get a cardboard hamburger, apple slices that were packed 100 years ago, and a little cheap toy. And it's like it's consistent. and it's able to be sold in multiple markets at the same, call it relative price points, and it's a consistent product. When I'm starting out getting out of the gates, I want to be all about consistency. I want to create the Happy Meal effect. I want to dial in my economic model small so that when I scale, I'm not scaling a problem larger. I'm scaling what is small profit at the unit level, at the Happy Meal level, or if I'm running a landscape maintenance company, it's at the truck level. If I can make one crew profitable, I can make all crews profitable. I recently had a billionaire who was talking to me about his giant service company. And he's like, this is world hunger. I got 6,000 vehicles. This company's lost its way. It's like, how do you fix world hunger? I said, you don't. You go right back to one truck, one service call. If I can make one truck, one technician, and the service calls that they perform in a day, if I can make a truck profitable, one truck at a time, I can take that magic, use the Happy Meal effect, and replicate it across all 6,000 of your trucks that are out there. I don't need to fix world hunger. That's why you've gone through 4 CEOs in a short period of time. It's like they're trying to fix from the top down. I need to fix from the bottom up, dial back to the unit level economics, get it dialed in small, and we'll be rewarded with an ability to scale right past that $1 million mark. Once I get past the $1 million mark, I want to replicate the same magic that got me to $1 million, and I want to focus now on building an economic formula for revenue and expense and capital expenditure that gets me to 10 million, of revenue. And then from there, usually it's like I have to start changing behaviors. And what I find is that a lot of entrepreneurs hit a glass ceiling. God bless them. They found success. They're one of the 7% that got to $1 million in revenue. They beat the odds. They're one of the 4% of that pile that got to 10 million. God bless them. They beat the odds. And most of them became, along the way, because of the Happy Meal effect, they became anal retentive control freaks. And so they hit the glass ceiling, which is, I got no more bandwidth. And I don't know how to go from 10 million and get to 100 million. And I tell people that your entrepreneurial career, your life needs to have a gear shifter, and when you're being an anal retentive control freak, that's what gives you the magic to be successful small, to create the Happy Meal effect. But when you get kind of, most entrepreneurs I see top out at about 20 to 30 million, and they need to find a new gear. And instead of being a manager of minutia, they need to become a manager of process. And instead of being the first chair player in every section of an orchestra, they need to learn how to be a conductor and trust other people to be the first chair players in every section that leads the section of the orchestra. Entrepreneurs who can find that gear are the ones who quickly go from 10 million to 100 million. And once you've solved that problem, I need to solve for capital along the way. I advocate that we bring in a financial partner, that we take a bunch of chips off the table, we become a rollover investor, and we now use somebody else's money to continue building the empire while we're diversifying our own net worth by taking some chips off the table, playing with house money now, and go for multiple paydays. Because what's better than selling your company once? It's selling your company multiple times.
Yes, absolutely. And for those that are running a business, what do you say is a good growth rate that they should be striving for?
So most companies, and I learned this at GE, right? So back in the Jack era, that company, world's largest company, is growing at growing earnings at better than 30% a year, which is phenomenal. And so if I can do that, let's compare some growth rates. If I'm growing at 10%, Law 72 says it's going to take 7.2 years for my business to double in size. I already told you I'm 60. I don't have another 100 years to go. So if I'm at $1 million of revenue, I beat the odds, and I'm growing at 10% a year. By the time I'm 67, I'll be at 2 million, and then by the time I'm at 74, I'm going to have 4 million. And by the time I'm drooling and in my 80s and wearing Depends, I'm going to be at 8 million. I still haven't got to 10 million. I want to get to $1 billion. In order to get to $1 billion, I got to grow much faster than that. 30% is a magical growth rate. If I can grow my earnings at 30%, and I say earnings because it's not just about revenue. It's
Mhm.
about also becoming more profitable as we get bigger, and my expenses should be going up at one pace while my revenue is going up at another. And that difference between the two, that's operating leverage that I'm creating because I'm getting bigger. Imagine my landscape company. If I have 1,900 trucks on the road, it's a whole lot cheaper to buy a bunch of trucks if I'm buying them 100 or 200 at a time versus buying one at a time. So everything I do should be getting more cost effective as I get bigger. But
Mhm.
as I'm growing this business and I'm expanding it, 30% lets me double the size of a company, not in 7.2 years, but in 2.8 years. And I can triple it in 4.2, and I can quadruple it in just over 5, which happens to be a typical PE, private equity hold period, the amount of time that they'll own a company before they sell it. And
Mhm.
so from my perspective, it's like 30%. I learned how to do that as a young guy at GE. And if the world's largest company can do it, so can you.
Mhm.
When you're a startup and you go from $1 in revenue to $2, that's 100% growth. Every company I ran had been in business for 40 years before I got there, and GE had been in business for 100 years before
Mhm.
I got
Right.
there. And so if you can make those companies grow at 30%, you're guaranteed a fabulous exit, about every 5 years.
Right. No, well that's great. And then from an EBITDA number, what are some numbers you need to get to from an EBITDA level to
Yeah.
consider, that would be good scale, but also consider an investment or a private equity firm coming in
Yeah.
and
So, again, I can find a buyer. There's so much private capital out there that I can find a buyer virtually at any size, but there are natural exit points. And it's at those natural exit points where there's the most competition to buy our companies, and we get the best kind of outcome. And it's a function of private equity itself. So we've got giant private equity funds with $30 billion in a fund. We've got small private equity funds that have 50 million, inside, and
Mhm.
we've got everything in between. But they
Right.
all do the same thing. They all invest 6 to 8% of their capital in any one company, and they never invest more than about 12% of their capital in any one company. They build this into their charter, their prospectus. It's like this is what we buy. This is the typical investment size. It's like asset diversification rules. We don't want to be overweighted. And so what it means is that big companies, big PE firms buy big companies. Small
Mhm.
PE firms buy small companies. And it's created these 5 layers in what I call the private equity pyramid. And each layer of that pyramid is about 5 years to climb from the bottom of that swim lane to the top. It's about 5 years. And that's the typical hold period because all PE funds last for 10 years. And on average, they hold a company for about 5 years when they buy it. And so, because of that naturally occurring phenomenon, it sets up kind of ideal exit points. And so the first real good exit point is $4 to $7 million in EBITDA. At that level, I can find really good partners who are traditional PE firms that raise money from limited partners that have a real fund. If I'm $1 million in EBITDA, chances are I'm going to sell to someone who calls themselves a private equity firm, but they're not traditional, they're not raising capital. And I wonder sometimes whether they have the real resources that we need to keep growing our business. It's almost like they're going to become the lifeboat. I'm the lifeboat for them. They're going to suck the life out of me. It's like, but if I get to 4 million, I can
Mhm.
find a really good partner who can be a really good steward to my employees, to my culture, and really help me accelerate my growth potential. So first great exit point, call it 4 to 7 million. Next great exit point is roughly 10 to about 17 million. And then
Mhm.
it jumps up to about 40, from there. And
Mhm.
and so if I can get to one of those natural exit points, I'm
Right.
going to be rewarded with a lot of competition and people who are willing to be aggressive to put their money to work to buy my company. If I'm in the middle of a swim lane, sometimes I'm too big for the guy who buys at the bottom, and I'm too small for the guy who buys up above, and there's actually less competition. I'll still find a buyer. There's still sharks out there swimming in the ocean, but I want to be where the sharks are circling, and I want to be where there's a lot of competition. And so I'm looking for, when I'm building a company, natural exit points. And those exit points are kind of 4 to 7, and then it's call it 10 to about 17. 40 to about 60, and then 100, and then 200, and then I'm a public company from there. So
Right.
that's kind of the natural exit points.
Yeah, well, great. And one of the sections I love in the book is your strategy and your management and showing different initiatives with your company. You use your conference room table analogy, which I love as well. How many people are sitting at the conference room table and what initiatives are they attacking? How they encourage people to check that out. But when you're considering a sale or you're considering an exit, you obviously mentioned the rollover equity piece of this. So why is that, one of your favorite ways to exit and something that you often recommend?
Well, most entrepreneurs think that selling your business is the end of the road. It's a one and done event. I work my whole life, I grow organically, and I'm not able to sustain a 30% growth rate. And so I get an exit and I ride off into the sunset. I see an exit as the first rest stop on a wealth creation highway. It's not the end of the road. Matter of fact, if I play my cards right, I'll do 3 exits in a 10-year period. And those subsequent paydays, if I'm growing my earnings at 30%, I'm going to get more, in the second payday than I did in the first. And I'm going to, so first payday, I sell the company, I take 70 cents home, I pay taxes, I got 30 cents, I roll it forward, small company, typical 4x multiple of invested capital. After working with my PE partner, getting a little bigger, within 5 years, I sell then 4x multiple of invested capital. The 30 cents I rolled over times 4 becomes $1.20. $1.20 is bigger than $1. It's like my second bite's bigger than the first. Do it again, sell it again, 5 more years. I can ride the coattails of the world's most sophisticated asset class and investors, and I can get multiple paydays, each subsequently bigger than the last. I spent decades working with private equity. My worst payday my entire career was 2 times my money. My best payday was 11 times my money. My career batting average is 5 times my money. And so I'm a believer in rollover investing. I'm a believer in asset diversification, multiple paydays, which helps me diversify my net worth. And, and I get to keep on going in a company I already know, I already love, with my great culture. And I just have shareholders coming and going as I'm getting bigger, and I'm substituting their checkbooks, for a new guy's checkbook to help me grow. And for them, I'm a tool. I'm a tool that gives them shareholder return. So it's a great marriage. They need somebody to run a company. They need a company, they need a great culture, and they need someone who can build a big empire. And I need money to grow an empire. And, there's a ton of it out there, but boy, is life easier. If you're going to go buy 20, 30 companies, if I've got an unlimited checkbook behind me, and relationships with debt providers, and I never have to worry about where my capital is coming from, my focus is entirely around growth. And so you can really accelerate the process of growing.
Well, great. Adam, I could talk with you for hours, but I know you've got to run. For those that are interested in following you and getting your books, where's the best place that they could find you?
LinkedIn, all my books, you can buy them anywhere books are sold, but obviously Amazon's the biggest book retailer in the world. So all of my books are available on Amazon. They're in Kindle, paperback, hardcover, Audible, but LinkedIn, people reach out to me on LinkedIn. They hear from me. I don't have a team of social media people plowing through my LinkedIn account every day. I carve out time, and I go through 100% of every inquiry I get on LinkedIn, respond to most. Sorry, I can't meet with everybody in person. I get 100 requests a day for that. And it's like, there's not enough time in the day, but I do look at them. You're talking to me. You reach out to me on LinkedIn, you get me. So that's the easiest place to do it.
Well, great. Adam, we appreciate the time.
Thank you. Appreciate it. Good luck to everybody out there.